I really wish you guys knew this stuff, which obviously you don't. So, but anyway, if you did, it would help with this chapter, or with this project a lot. That's funny. Come on, you should be laughing. Okay. What we're doing is just calculating the present value of future cash flows. Only what we're going to do is we're going to treat it as an annuity, and typically we treat it as an ordinary annuity. The cash flows are an ordinary annuity. And it doesn't even have to be an annuity where the cash flows don't grow. And by the way, growth could be positive or negative. Cash flows can increase growth rate, or they could decrease. Okay? So this is a nice little model for trying to value a company. I think this is real financial analysis, not calculating all of the ratios. I think this is really valuable financial analysis. The reason I like to do this in intermediate accounting is I want to show you what people are going to use the financial statements for. Okay, so finance types will be using this model all the time. Well, if you're an accountant, you understand how financial statements are used, it really benefits you. So the numbers that are in the financial statements really matter. And we're going to make all kinds of predictions based on those numbers. That's what we're doing here. The other thing that's kind of nice is I'm going to have you go out online and look up real companies. So you're going to read real financial statements, which is probably going to be the first time you've done that. Am I right? You guys been out there online looking at different companies? Have you? Good.
I just got them.
Oh, well, you've been looking at Yums pretty closely. Yeah. Okay. That's really good experience. Yeah. It is. Okay. So did you write some of the disclosures?
I've
Yeah.
had to work on something.
Been working on getting the numbers together. Good. Okay. That's good experience. So anyway, what we're going to do is we are going to say that the future cash flows are an ordinary annuity. Okay? So the future cash flows, we're going to assume at first that they're the same every year forever, and then we'll add growth to that they could be increasing or decreasing, okay, over time. All right? And the number of periods is forever. Infinity. Okay? Really important point. So how do we figure it's for infinity? When I buy a share of stock, I pay for all of its cash flows forever. Discounted back to now. All the earnings they're ever going to have, earnings per share, right, that are going to convert into dividends or an increase in share value, right? So then when I sell it, I have a gain. I'm going to have to buy all the future cash flows that are ever going to happen to that company forever, right? Now, obviously, companies don't last forever. But here's the deal. If they last for more than 20 years, what's the discounted present value of $1? Say at 12%. Markets are 12%. For 20 years. How much is that? What's that? What's 1 over 1.12 years? We just do 20 years. Versus if we do this year. What's that? What's this dollar worth and what's that dollar worth? This is one received 20 periods from now, discounted at 12%. This is one received 1 period from now, discounted at 12%. All right, guys? What's going on here? Yeah, you hopped up a little bit here. This stuff's not going to be too easy. Once you see it, it's going to be. So what was the first one?
0.10366.
103? Oh, 0.0366?
0.103.
0.10.
It's worth 10 cents?
Yes.
All right? Okay. Just 20 periods from now. How about if I do 50 periods from now? That's nothing, right? It's already getting small. Getting the idea? What's this one? 0.8. All right, so it's 89 cents. Got the idea? This dollar is far more important than this dollar. Ah, no kidding, right? So when we say to infinity, yeah, it's to infinity, but after you get out about 20, 30, 40 years, what's the deal? Those dollars are meaningless, okay? And mathematically, it makes it so much easier if it's to infinity, okay? We can do it mathematically. Otherwise, it's kind of almost impossible, okay? And there are different models that try different ways, but this works pretty good, okay? So what we've got is cash flows that are really an ordinary annuity going forward, okay? And forever. And what we need is a discount rate. And when you walked in, and David said, oh, we're going to be calculating that little I, what is that? In this model, what is it? Okay, for debt, it's the interest rate, right? For equity, it's, so that for debt, it would be an interest rate. And it's interest rate less, or times rather, 1 minus the tax rate. It's less taxes. Because the government picks up part of the interest, because you put the interest in your tax return. Every dollar I put on my tax return, if I'm in a 40% tax bracket, saves me $40 expense, right? Saves me 40 cents of taxes. So it only costs me 60 cents, not a dollar, right? So if I have interest, the interest is saving me taxes, so the after-tax cost of the interest is what really matters. So that'll be the interest rate times 1 minus the tax rate. Yeah, so do that. And then what about for the equity, what do we use? Yeah, what discount rate? What do we call the discount rate for equity? We estimate how much the cost of the equity is. It's the capital asset pricing model to determine the cost of equity. So this is going to be cost capital. Oh, by the way, why do you use K instead of C? Because in economics, C is consumption. K is cost. That's it. Okay? They're not trying to be clever. Okay? We use D because it's debt. Like it. Cost of equity, we use E because it's equity. No kidding. Okay? So cap in and the cost of debt. Okay? Yeah, not bad. So that's going to be our discount rate. And what do we want to calculate? If you're going to calculate how much you're willing to pay for a company.
Okay.
We want the present value. That's what we're looking for. And that's all this model's doing, you guys. It looks like a whole bunch of stuff going on, but that's all it's doing. Okay? We are going to come up with a discount rate. We're going to come up with estimated cash flows, and we are going to calculate what's worth. What do you get your cash flows out of? What do you invest and generate cash flows with? Which one of those numbers? Assets. You bet. Your assets are what you have invested. Whose money is it? Debt holders and equity holders. What do you pay the debt holders? The interest. What do you pay the equity holders? You better give them their expected return. If you give them their expected return, the stock value will stay exactly the same. Right? You give them their expectation. If you beat their expectation, what will happen? It goes up in value, right? Because they're earning more than they expected, so it's worth more. Okay? How about if they earn less? Stock value go down. That's it. So this cost of capital, CAPM, is how much the equity holders should expect given their level of risk, right? And what are interest rates composed of, you guys? Interest rates in general are composed of what?
Pure interest rate.
Pure or true or real or nominal, whatever you want to call it, right? I don't know why, but I always call it true return. I probably had somebody 100 years ago call it that. Okay, plus
Inflation.
expected inflation, right? Most people agree that this is 2 to 3% researchers. This is whatever it is at a particular time. Right now it's not very much. How do we know that? Because the T-bond rate, which is our proxy for what? The T-bond rate is our proxy for what? This paper you just read. For the risk-free rate. 30-year Treasury bond. We think the 30-year Treasury bond is the most, or is the longest risk-free investment there is. Because the U.S. government guarantees the debt. It's pretty risk-free. The U.S. government can do what? Have more money, tax people, sell assets, right? They're going to pay it. They're going to pay the interest. We're going to keep our good credit rating. Although Congress keeps going in circles every once in a while saying that we're not really going to pay the debt, right? The whole world economy starts freaking out. Actually, for a while, they were going to get rid of the 30-year Treasury bond. I was kind of freaking out. What's the market going to use? The risk-free for a long term. There are 5-year Treasury bills and 10-year, that sort of thing. They're a lot shorter. Anyway, this is the risk-free, you guys. So what's risk-free composed of, theoretically? True return plus expected inflation. And then what's the other piece? You said there were 3 pieces. I agree with you. What's the other piece out there? Risk premium. So it's for risk, right? So it's the risk-free plus a risk premium. That kind of makes sense, doesn't it? And what we are going to do is we are going to estimate the client's, the company's, risk premium. Okay? And we're going to add it to the risk-free. And you know what their cost of capital is. Right? There are methods of estimating what the cost of capital should be for debt, too. What should the interest rate be? And guess what? It's risk-free plus a risk premium. Right? It's always risk-free plus a risk premium. Does risk-free ever change? Yeah, true return never changes. It's always 2 to 3, we assume. That's the rent of your money. But does expected inflation go up and down? Sure. Right now it's real low. How do we know that? What's the 30-year Treasury bond right now? Did you guys look one up yet? So it's around 3, I think. So, you know, if you got 2 to 3 plus some number equals 3, what's the number? 0 to 1%, and that's the kind of inflation we've had in recent history, right? Inflation's real deceptive, though, because people say there hasn't been much inflation. My wife wants to buy a car right now, and the car that she bought 10 years ago for $31,000 had a sticker. She told me that yesterday, so now again, it was $31,000, and it had a sticker of $39 on it. Now, exact same car as a sticker of $42, so that doesn't sound like much inflation in 10 years, does it? They want $39 for it. There's a lot of inflation. 31 up to 39 for exactly the same car. But then cars are real popular right now. Everybody's buying cars, right? You see all kinds of new cars. When the stock market collapsed in 2008, nobody bought cars for a while, right? Everybody thought the auto industry was going to die, right? And things go in cycles, okay? So automobiles cost more now. Food costs more now. Energy costs less because of natural gas exploration, right? And production. Wow. Oil is much less. Gasoline costs half as much as a few years ago, doesn't it? But the balance on inflation is pretty low right now, okay? Pretty low. It has been for a number of years, and maybe that'll stick. So anyway, that's kind of what this model's doing, you guys. So let's walk through it a little bit. Let's walk through what the formulas are. If you look at, there's your syllabus there, case, yeah. If you look back, yeah, I don't know, other office, and realize that's their own. If you look at, Bill pulls it all together, is that what you use? It's page 11. If you look at that, and what we tried to do was put this in English, it was for MBA students, not for mathematicians. So I think it works pretty good for you guys too. By the way, you'll quit using the words, use the formulas, because why would you use the formulas to their words? Because it's short. It's just shorthand. So, you know, you'll convert it into some sort of a formula. But I think the words are really pretty handy at first, so you have an idea what you're doing. What are the two things we need to calculate present price? Yeah.
We need the interest.
Okay, we need an interest rate. Okay, so we're going to come up with that. That is going to be what? I said cap M in interest, right? Interest rate times 1 times the tax rate. But then what we're going to do is take it times the weights of debt and equity. And then what do we call that? The weighted average cost of capital. It's really a good name for this model because that's what it is. It's the weighted average cost of debt and equity. Okay? So that's going to be our interest rate. It's going to be WACC. Right? And then what do we need? We need cash flows, don't we?
Yeah.
Right? So because this is going to be future cash flows. So my future cash flows, I'm going to get an estimate of that based on what? It's just going to be the estimated cash flows. But they're future, right? It's an annuity, isn't it? And I assume the cash flows come at the end of the year. That's conservative. Really, they come evenly through the year, maybe, or well, whenever they come to the company. So this is future cash flows. And it's really an annuity, and it's an ordinary annuity. Okay? That's basically it. Okay, we're going to estimate that. What are we going to estimate based on? Cash flow statement or income statement?
Okay.
We're going to use the income statement. Why are we using the income statement? You can't manipulate it like you can a cash flow statement, right? Cash flow, you can just not pay your bills, more cash, right? Buy assets, you have less cash. So you can manipulate how much cash you have. That's just cash in and cash out. On an income statement, your income is probably the best predictor of future cash flows we've got. So we're going to use that. Okay. By the way, we add back depreciation and amortization to income too, don't we? Why? What's the journal entry for depreciation?
Depreciation expense accumulated.
Debit depreciation expense, credit accumulated depreciation. Anybody here cash in that one? I don't either. The cash goes out when you make the investment in the first place. Okay? All right. Still fine. All right, so what else do we need? Number of periods, and what did we say the periods are going to be? I'm buying all the cash flows forever. And then when I sell it to you, guess what you're going to give me? All the cash flows forever. And when you sell it to him, what's he going to give you? All the cash flows forever. All of them discounted back to now. That's what happens, right? That's the deal. You know, if I'm only going to invest for 2 years, I don't just pay for 2 years cash flows. I have to pay for cash flows forever coming out of that share of stock, right? But then when I sell it, I get all the cash flows forever, right? Less, I guess, the 2 years I took. That makes sense? Why doesn't it go down in value? Because people expect the cash flows to continue, right? And they're sooner. 2 years went by, right? The next year is sooner, so they're worth more. Got the idea? Okay, so the values are changing. How do the values change? As the cash flows change and as the discount rate changes. The value of stock changes. That's it. The number of periods are too, that's infinity out there, right? Number of periods is to infinity. And what am I calculating, everybody?
Present value.
Yeah, if you knew an interest rate and you know the ordinary annuity payment, right? And you know the number of periods, you could calculate the present value at time 0, and that's what we are doing, okay? Everybody's good with this now. Comfortable, sort of. All right, let's write down the model. How do you get your estimated cash flows? This is the finance version of the model. I think what it is revenues you expect to continue into the future, less expenses you expect to continue into the future, plus gains you expect to continue into the future, less losses you expect to continue in the future. I think it's income you expect to continue in the future, after tax, because the government's going to take tax out of it. That's what I think it is. What does this model say? Operating income? Well, be careful. I would agree that if there are discontinued operations, you wouldn't include that, because it's discontinued. You don't expect it to continue. Extraordinary, by definition. Extraordinary items, they're supposed to be unusual and infrequent, right? I wouldn't include those either. But I agree with that. What about non-operating things? This says operating income. What about non-operating things? If they're going to continue, I think you should include them. Don't you? So when we say operating income, what do I really mean? The income you expect to continue in the future before taxes, right? And then you take it times what? You're going to subtract the taxes from it. Take it times 1 minus the tax rate. And will that give me net income after tax for some companies? Yes. For other companies, it won't, right? Because you are going to adjust this operating income to be what you think it needs to be going into the future. You take out your crystal ball. It's your best estimate of what's going to happen in a normal year in the future. Got it? Okay? And then same with the tax rate. What's a normal tax rate? You wouldn't use just the most recent year. Probably take an average of the last 3 years or something, right? Go analyze it, figure out what it should be. Okay, so we multiply those two together, and then what do? Add back non-cash items. We assume there's just one massive one. What's the big non-cash items? Depreciation and amortization. Now, I'll tell you what. This is a very simple model, and it just makes sense. What's really weird is it works. Unless the market's going crazy, up or down, and then it doesn't look like it works anymore, and then the market kind of normalizes and it works again. I think the market's got this problem. The theory's probably pretty good. Okay? By the way, this is going to give us an independent estimate of what we think the stock should be worth. Then you compare that to what the market thinks it's worth. How do I know what the market thinks it's worth?
Look at that.
Yeah, it's what it's selling for, right? What am I looking for? Where the market thinks it's worth a lot less than I think it's worth. And I can't figure out why. And I keep working and working, trying to figure out why. And then what do? I buy it, wait for it to go up and get rich. Unless I'm wrong, of course. Right? And it goes down. So it gives me some information. That's what I mean. It's financial analysis, huh? What do you think the stock's worth? So it's nice to have your own estimate. Is my estimate necessarily better than the market's? No. The market's what it's really selling for. But I don't care what a stock's selling for now. What do I care when I buy it? What it's going to sell for in the future. I don't know if it's going up or down. Right? That's what I'm trying to predict. If I think it's worth more than it's selling for, what's it probably going to do? Go up. If I think it's worth less than it's going to selling for, what's going to probably happen? Probably going to happen. Market will find out. Okay? So that's sort of the game. Right? And you take as much knowledge as you can get pump into this thing. Okay? So it's really qualitative. It's not quantitative. The model's pretty simple. All right, that's going to give me my estimated cash flows. Well, what do I want to divide into my estimated cash flows? I want the weighted average cost of capital. Because what I'm going to do, you guys, it's going to look like this. I'm going to take my estimated cash flows. Oh, by the way, I asked you, do those cash flows come from your assets, liabilities, or equity? What do you invest in? Assets. The assets generate the cash flows, right? Some of those are financed with debt, some with equity, but the assets do. So when I divide this by weighted average cost of capital, so what I've got here is an annuity, right? Annuity forever. Future value annuity forever, assuming I get it at the end of each year, huh? Okay? Ordinary annuity then. Divided by WACC, which is forever, will give me what? Estimated market value of what? Assets. My assets. Because my assets are generating all that cash flow. All these cash flows came from all these assets. And the rate I should be earning on them is WACC, the weighted average cost of capital. So it's an estimate of what the assets must be worth. And I will subtract from that what? Estimated market value of what? Assets less what? Liabilities equals an estimate of what, guys? Assets less liabilities is what? Equity. Estimated market value of the equity. Here's an accountant's way of doing this. When Dan Bauer sees me do this in the MBA, he's like, wow, that's really cool. And now he's used it even a little bit more. He still uses the finance mathematical books and stuff, but he explains it this way, right? That's what it is. And you know what? There's going to be the cost of the assets, that's WACC, and we're going to have cost of the liabilities. What's that? That's the interest rate times 1 minus the tax rate on the debt, right? What we're paying for it. We pay the interest and then the government gives us a tax rate, right? So it's an after-tax cost. Everybody staying with me on that? Okay? And then the cost of the equity is going to be what? Capital asset pricing, what we expect to have. Okay, so to get the WACC, what are we going to do? What's this going to be? It's going to be the cost of the debt cost of the equity. The cost of the equity is CAPM, okay? This is the capital asset pricing model. This is the interest rate times 1 minus the tax rate. After-tax cost of equity. Times the weights of each. So what we're going to have is the weight of the debt and the weight of the equity. The weight of the debt plus the weight of the equity is going to add up to what? 100%. How you finance 100% of your assets. It's as simple as that. It's like this. If this is 60%, now, this is 100% of itself. What's this one? 40%. All we're going to do is get an estimate of that. But do you want that estimate to be on the book values of liabilities and equity and therefore assets, or do you want it to be on the market values? I think the market values. What do you have to pay for the stock? It's book value or it's market value? It's market value. And isn't the market value significantly different than the book value most of the time? If the company's doing really well, it's far more, right? Because what is market value? Historical cost on all the assets, remember? For most of them, some are at fair market value, but lots are at historical cost. Even depreciated historical cost, right? Even the liabilities are at historical costs, okay? Probably closer to the market value, we hope so. And then equity, right? Well, the market value of the equity is far more typically than the book value, isn't it? The market value, the book value of the equity is what was paid for the stock, paid in capital in the first place, right? Plus retained earnings, right, guys? So if there's a lot of future earnings expected, it'll be much higher, okay? What if there's no future earnings expected? And it'll be lower. It's snowing. Looks white behind us. Just get heavy raindrops. They're full. Looks like it might be wet snow. Anyway, it's getting colder. Okay, how are we going to get the weights, though? How much is it? 36 degrees. Oh, it can't be snowing unless it's really wet. Sun on the raindrops. Well, no, I mean the drops that are coming down. Are big. Maybe it's not falling. There's nothing in the trees. It's Okay, anyway, so where are we going to get this stuff? All we're going to do is get these weights, right? This is going to be the income off the income statement and the tax rate off of the income statement, right? Depreciation, amortization, where are you going to get that one?
On the income statement.
Except we might not have it on the income statement, most companies don't. It could be there, but there are manufacturing companies can be very cost of goods sold a lot of it, right? And it might not be there even if it's not really huge, they won't have it there anyway, it's always somewhere. If it's not on the income statement, where is it? Or we can always count it.
Difference between accumulated depreciation.
No, it's not the difference because you might have sold some assets, right? And then you retire accumulated depreciation. Oh, come on, you guys. Where do we always add back depreciation to get to cash flow? You guys ever done a cash flow statement before? I know you know how to do one, right? Don't we add back depreciation to do a cash flow statement? It's always there. It's always there. You just go there and get it. I'm not kidding. So getting this number is a joke. Getting all these numbers is really easy. This is going to be simple. On real financial statements, it's even pretty simple. Okay? It's just deciding which numbers you want to keep and which ones you don't want to keep. That's the hard part. Where are we going to get the weights, everybody? What we could do is we could take half. We can do this. So the weights, assets equal liabilities plus equity. I come up with a proxy for the market value of the stock. This is a pretty good proxy. And this makes our model circular, by the way. I had a guy in class that actually said that. He says, your model's circular, it's not valid. And I says, I know, circular, it's a weakness in the model. Because you're using what you're predicting to predict, right? Kind of weird. Because we're going to use the market value. We're going to use the number of outstanding shares, guys. The number of outstanding shares times the market value per share. What's that called, by the way, when you look it up out on Yahoo Finance or MS Finance? Well, not earnings per share. The number of outstanding shares times the value per share. It's market capitalization. This will be called market capitalization. So you can actually look it up, right? Out on Yahoo Finance or MS Finance or something, Value Line or something. Right? You can look the thing up. That's market cap. But that's what the equity's worth at that moment. The number of shares that are being traded, the outstanding ones times the market value per share must be what the equity is worth. It is at that point in time, right? Okay, so we're going to use that for the market value of the equity. So these are market values. Got it? Market value. I want the market value of this one too. What's going to be my proxy for that? The liabilities. I am going to use the liabilities from the balance sheet, right? I'm going to use the liabilities from the balance sheet and say that they are approximately, the book value is approximately the same as market value. Does that have to be true? What if the company has bonds? Could you find out what their bonds market value is? Sure, you can look it up. They're being traded, right? So you could find that, or you could calculate it. You guys learned in 101 how to calculate bond values, didn't you? Okay? So what do you think here? Why do we use book value to approximate market value? I'm going to use book value as a proxy. A proxy is you give somebody your proxy vote, they can vote for you, right? If you're a member of a board or something, you give one of the board members your proxy, they can vote your votes. If you're a shareholder in a company, right, you give somebody your proxy, they vote your shares. You like the way they run the business, whatever. Okay? Where they want the business to go. All right. So that's going to be a proxy, but we still say it's a market value. Okay? So what do I have on the assets? I have the market value of the assets. Okay? So don't use the book value of the equity. That's the thing that people screw up a lot. Okay? It makes your weights wrong. Okay? So what I'll do then is I'll say, all right, if this, let's say this is 100 million. This is 60 million. And this is 40 million. What would I do? The 100 million is 100% of itself. The 60 million is what? 60%. That's where you get these weights. The 40 is what? 40%, whatever they are. Okay? Got it? Based on the market values. what happens to the market value of stock changes? All bets are off. You're only valuing the company at the particular time that you're doing this, right? You're doing the calculations. If the value of stock changes, the number of shares change, or anything changes, all bets are off. Okay? All right. So now, where would you get this one, this interest? You might take the interest expense
And divide it by
on the income statement and divide it by what? Average debt. You can do that. It was a little problem I gave you, that's how you had to do it. Or that would be the interest expense, right? That's interest. Where would you get the tax rate?
tax expense
You could take the tax expense for the tax rate, you could take the tax expense
and divide by the income.
and divide it by the net income before tax, couldn't you? And that'd give you your tax rate. Yeah, you want to do that, but you could also look at the notes of the financial statements. You can find out what this year was in the previous 2 years. Also, in the income statement, they're going to show 3 income before taxes of three tax amounts. You could calculate each of them there too, and then decide what you think is normal. By reading the tax note, you can figure out what you think would be normal for the particular company too. If they have 1 year that's unusual. So don't just use the current year. If the current year is not normal, then you're not going to have a very good valuation. Okay? So once you have the interest rate and the tax rate, what do? Take the interest rate times 1 minus the tax rate, and you're there. Okay? How do you get capped in? Okay, now this is different. What do you do for capital asset pricing model? What is the formula, guys? Everybody has to pay the risk-free rate, right? That's risk-free rate. Plus what? Beta times return on the market, the rate the market would be expected to return, minus risk-free. Okay, look, this is what you could invest in risk-free. What are we going to use as a proxy for that? The 30-year Treasury bond. By the way, different people have different attitudes about what to use. So a lot of people would say you should use a shorter one because how long you intend to hold the investment. I'd say that's true if that's the end of the investment. But if the company's continuing forever, somebody else is going to buy those future cash flows from me. So I don't think that works so well. So I like the 30 better, right? If I invest in something that was going to be a 5-year project, and at the end we were going to disband, right, and liquidate the thing, of course I'd use a 5-year, right, for risk-free. Because it's a 5-year deal. Same with 10 or whatever. Use the one that's closest to your horizon, but not your investment horizon. If you buy the stock and you're going to resell the stock, that stock's going on forever, at least in perpetuity, right? Okay? All right. So what's the return on the market? It's what the market would be expected to earn over time. So I think this is like 12 to 13%. Risk-free, what's that? Whatever it happens to be. Right now, it's only 3%, which means return on the market is probably less. So, but yeah, over my lifetime, or investing lifetime, that's been 12 to 13%. What's probably a normal risk-free is maybe 5 or 6%. What would that mean? 2 to 3% of true return, real return, nominal return, and 3 to 4% inflation, right? Right now we don't have any inflation, so that's around 3%. Make sense? But what happens then is the return on the market goes down. So the expected return on the market now might be 8% or 9%, okay? Instead of 12 or 13, unless inflation fires up again. What's the deal here? What you have is a risk premium, which is the difference between what and what. The risk premium on the market is the difference between what and what.
The market and the free.
Yeah, the return on the market and the risk-free. So it's how much extra you get for taking risk. Make sense? So let's say the market would earn 12%, and the risk-free is 5%. That would make your risk premium what? 7%. Everybody agree? But the market expects to earn 12. And then the risk-free over here would be the same 5%. Well, what's 5% plus 7%? It's the 12. So this seems kind of silly, right? You just separated it into 2 components, didn't you? But the reason is we're going to use this beta And what this is a proxy for risk. And it's a proxy for the risk of an individual stock compared to the market. It is the covariance of the returns on an individual stock with the returns on the market as a whole. So you might use the S&P 500 or something, right? A major market, a big market. What it's really supposed to be theoretically is all the investments that are in the world, okay? Everything's possible, but obviously we don't have a major for that. So what we do is we do a covariance of the returns on an individual stock, right? Over time. So what their dividends are and what their change in stock value is added together, okay? And you compare that to what's happening in the market as a whole. So what's their percentage returns compared to the markets over time? And what it is a measure of is how much they fluctuate. So a beta of 1.0 means it fluctuates exactly with the market. It goes up and down with the market. Beta of 1.0. We would say, well, that has the same risk then as the stock market. And if I put 1 in this formula, what happens? 1 times 7% plus 5% is 12%, huh? What though if it has a beta of 2.0? We think that's much more risky, like twice as risky as the market. 2, because it varies twice as much. Here's the theory of that. If the stock price, or if the returns, the dividends and the change in market value of the stock price go up and down a lot for a stock, what if you had to sell it and it's down? You lose, right? What if it goes down too much? What happens? Probably means the company's gone bankrupt, right? So are companies with more variability, both up and down, more risky than one that has less variability? Yes, I think that's true. I think it makes sense. If a company has very little variability, what do you think? It's not very risky. Its beta would be real low. Got it? Because it'd be tracking with the market. Okay, yes, sir?
I mean, it could be lower than 1, can it?
Oh, yeah, sure. Well, first let's do the math on this. This would give us 12%. Does everybody see that? 5% risk-free plus a beta of 1 times 7% risk premium is going to be 7, so it's 12, isn't it? What if my beta is 2? Let's do that one. The only thing that changes is your risk premium. You're still going to, the risk-free is still 5% here, right? Which I'd have 2 times 7%, which would be 14, everybody agree? Plus 5, that cap in would be 19%. You have to earn a lot more money because it's risky. That's it. Expected returns much higher. Got it? But you're right. What if it's 0.5? It can be less than 1. That just means it's less risky than the market. Well, not really. It means there's less variation of returns compared to the market. It's a proxy for risk. So we think it's less risky than the market. If you got 0.5, what would happen? 0.5 times 7% would be what? 3.5. Add it to 5, and what do you have? 8.5%. Got it? By the way, what happens to cash, the present value of cash flows if you use 8.5 versus 19? You discount something at 19, it's not worth as much as if you discount $1, say, at 19%, as if you discounted 8.5, right? 8.5 is worth more. You have to generate more dollars, right, to justify that 19.5%. You're a higher risk investment, okay? So we're going to discount the cash flows based on how risky we think they are. Well, haven't we been doing that all along? You know that quiz that you just really did so well on? You guys should smile about that. It's kind of fun to totally wipe out on something. Don't you think? It's not a blow to your ego. It's just work, right? Get your ego out of it. It's work. Every time I start worrying about how well I'm doing at something, I screw up. Still. Couldn't sleep last night because I made a decision. And then I started thinking about, God, did I think about this? Did I think about that? But I really screwed this situation up now with that decision. You know, so you make a decision, you think it's the right thing to do, and you do it. Everything looks like it's going to be great, and you start thinking about all the ramifications of your decision you might have forgotten about. And there go the next week, right? I raised your tax instead, which was really uplifting. At least I got some laughs out of that. Right? 5s and 4s, 7s. Okay, that's fun. Anyway, I could write a quiz where the average in the class was 0. I know how to do that. I can easily write one with the average is 25 cash. What I'm shooting for is about 12. And probably 13. It's going, right? But it won't fives, not really. That's kind of depressing. Okay, so you'll fix it. I know you will. If I were to give you another quiz like that the day we come back from the break, will you be able to do it? The answer is yes. Be able to nail it, right? Because you'll discipline yourself, right? You'll work, you'll get it down. Okay? So every time you drop the ball, what do? Take it back up. Work harder. Keep going. Keep going. Keep going. So it's kind of neat watching U of L. And it wasn't their last game, but the one before that where they lost a couple in a row. You know, after they found out that they're not going to get postseason play, and you know, these kids are really depressed. So you know, their edge was gone. So they got beat. I think they lost 2 in a row.
No, that one was the first one.
You know, it was one. Yeah.
Yeah.
2. They did lose 2. And then in the first half, the first quarter of the game, they were way behind, and then all of a sudden, they just. I think it might be even at halftime or something, and then they slaughtered them. Just went crazy. And then ever since then, they're back, right? They have to pick up the ball, right? Keep going. Stay in the game, I guess. Anyway, sports analogies. So, all right. We're about done. That's terrible. Well, so what'd you do in that problem? What'd you do in that problem? It was pretty easy, wasn't it? What does it ask for? What are we going to do, you guys? Estimated cash flows divided by weighted average cost of capital. Go after it. And that's going to be the estimated market value of the assets. You need to get this so it's just automatic before I see you again. Minus the estimated. Besides, I look at it and I think I don't have to memorize this. It's common sense. I think you guys know that assets less liabilities is equity. I don't know. I think you know that estimated cash flow is divided by discount rate. Oh, by the way, why don't I have to take, this gives you estimated market value of liabilities. Why don't I have to take estimated cash flows times 1 over the cost of capital, 1 over the weighted average cost of capital?
Because those are both infinite.
It's to infinity, because it's to infinity. What this represents is the estimated cash flow divided by 1 plus WACC raised to the first, right? Plus estimated cash flows divided by 1 plus WACC, 1 plus the discount rate, right guys? It's discounting, raised to 2 periods, getting my drift? And you keep right on going, and the last one, year after year after year after year, okay? The last one would be estimated cash flows divided by 1 plus the weighted average cost of capital. So that's the same thing as taking it times 1 over 1 plus the WACC, right guys? Discounting is just dividing to infinity. Mathematically, you used to be able to do the proof. I don't think I could do it anymore. Mathematically, what this breaks down to is this. You don't have to take the 1 plus. You can just take the estimated cash flows 1 time, and you can divide it by, in this case, WACC, the interest rate. If the cash flows are forever, this collapses. And it makes sense if you think about it. This is a big number, this is a smaller one, each one going across gets smaller and smaller and smaller until it approaches nothing, right? So it works. Here's another way to get it intuitively. How about if my cash flows are $100,000 a year and my WACC is 10%? How much asset investment would you have to earn it to justify this? What would this asset have to be? What does it have to be? How much would you have to invest to justify earning 10% of 100,000 cash flow forever?
1 million.
Yeah. It would, right? If I knew any 2 of these 3 numbers, I could calculate the other one. That's all we're doing. We're saying, look, I estimate the cash flows are going to be 100 forever, or whatever it is, of course. I estimate the WACC, 10% in this case. So what investment here would I have to make to be earning exactly 10% if I have 100,000? just 100 divided by 10. Well, you go the other way, couldn't you? If I had $1 million invested, I'm going to earn 10%. What should the cash flow be every year? 100. Be 100 and you take it out. You don't reinvest. Okay, take it out. Everybody got it? This is simple, isn't it? If you knew the 100 cash flows and the million market value, could you calculate the 10%? Of course. Everybody got it? So now, give it another shot. Said you, how many of you worked this problem? Tried. Didn't work very well. Try. You're gonna have it. Work it. Make it work. And then as soon as you're done with that, I want you to go out online. Which ones did I suggest on your syllabus? Target?
Yeah.
Was it?
Fair target.
Over the break, value target. What was the other one? Young? Target Young. And any other companies you want. Feel free to do Walmart. I don't care. Right? People like to do companies that work for you. Do whichever company, unless you're working for a bank, then don't do it. Different. There it is. Okay? But yeah. Use some real ones, okay? So and then what we'll do next time is you guys will tell me you have the answers on this problem. Okay? And then I'll ask you what your stock valuations were for Young and Target, and we'll all make fun of each other with our answers. Oh, that's next time. Well, I'm thinking after the break. Oh, on Friday you won't get them both done. Do this one if you guys haven't done it yet. Do this one, and then do one of the companies. Which one should we do first? Target?
Yeah,
Do Target. And then over the break, we do a couple more. All right, that's good. We have a good day. Just trying to get rid of you guys on Friday, you know. Let's not do that. We should probably actually learn this stuff, huh? It'd be okay if I cancel class?